Good morning, traders, and welcome to BCR's morning market analysis. First up, let's talk about the US dollar. The DXY pushed above 97.7 on Wednesday, extending its recovery from late February lows as markets reduced expectations for aggressive Federal Reserve rate cuts. Fed meeting minutes indicated deleveraging could take longer than expected, with some policymakers even raising the possibility of rate hikes if inflation remains elevated. Um, January CPI came in at 2.4% annually, below expectations, but still above the target, while improved US EU relations and easing aversion to the dollar assets also supported the sentiment. Weakness in other major currencies further lifted the DXY. From a technical perspective, the dollar has formed a V-shaped reversal and is trading above key moving averages and the Bollinger Band mid-levels, reflecting bullish consolidation. MACD momentum is building above the zero line, although strength remains moderate. Resistance sits near recent highs and psychological levels, while initial support lies around Bollinger and psychological zones below the current price. Next up, let's have a look at crude oil. WTI crude gained more than 4%, breaking above $65 per barrel and testing monthly highs as tightening supply and strong Asian demand squeezed the physical market. Supply fell by around 1.2 million barrels per day in January due to winter shutdowns and export restrictions, while demand from China and India absorbed the available flows. Added geopolitical tension in the Middle East has increased the risk premium, particularly around key transport routes. However, potential OPEC production increases and gradual Venezuelan export recovery continue to shape the forward outlook. In the near term, prices may maintain upward momentum or stabilize within support ranges. Although global oversupply remains a structural theme, RSI remains above the midpoint, but turning lower, and key support and resistance areas are clustered around the moving average and psychological levels. Next up, let's have a look at gold. Gold traded around 49.90 per ounce on Wednesday, supported by mixed signals from FOMC minutes and ongoing uncertainty over the policy path. Diverging views among policymakers, ranging from holding rates steady to potential easing, left markets pricing a data-dependent outlook, sustaining gold's appeal as a hedge against policy uncertainty. At the same time, improving risk sentiment and geopolitical negotiations reduced the urgency for safe haven flows. Technically, gold has slipped below the key psychological and retracement levels, maintaining an overall bearish bias. Market focus remains on central bank policy signals and geopolitical developments. Support lies near the moving average and psychological levels below current prices, while resistance is still aligned with moving averages and recent highs. Lastly, let's have a look at the Australian dollar, which slipped slightly below 71 cents but stayed close to the multi-year highs as investors evaluated RBA meeting minutes and strong wage growth data, which reinforced inflation pressures and labor market tightness. Annual wages grew 3.4% in December, and policymakers noted a significant shift in inflation risks following the recent rate hike to 3.85%. While further tightening is not guaranteed, upcoming employment and GDP data are expected to guide expectations ahead of the March meeting. Technically, the Australian dollar rebounded from its rising 100 period moving average and maintains a short term positive bias while trading above the dynamic support. MACD indicates easing bearish pressure and RSI remains neutral but rising. Resistance levels remain clustered near the psychological highs and recent peaks, while support sits around the moving averages zone and round number zones, which are psychological levels on the Australian dollar. Well, that's all for today's morning market analysis. As always, manage your risk and happy trading.